Santa Claus came early this year, bringing a bundle full of good economic news in the week before Christmas. The government released its third and final economic growth rate for the third quarter of 2016, revising it upward for the second time. The growth rate for the third quarter had initially been estimated at 2.9%, but was revised to 3.2% a month ago. Santa's elves must have been working overtime to come up with a final growth rate of 3.5%, the first of many nice surprises from Santa. These four charts are the components of economic growth: consumption, investment, government activity, and net exports. When you add them up, are equal to the growth rate of the economy, 3.5%. Investment has risen 2 months in a row now, confirming that a long dry spell is over and inventory is being replenished by businesses. And Santa surprised everyone with a gift that could keep on giving in the quarters ahead. U.S. net exports suddenly shot up. A growing Chinese middle class are eating more soybeans, triggering a sharp rise in net exports from the U.S. By far, the most important of the four components of GDP growth is consumer spending, which drives 69% of GDP growth. Last month, the consumer spending spree slowed, but the slope of the red line shows the longer-term trend. That trajectory puts consumer spending on a 10% growth plane. Employees are clearly high on Santa's list this year. Just released personal income figures for November shows employee compensation is booming. Wages and benefits are up 3.6% year over year. But, as the elves often say, it's not what you earn that matters, it's what you take home after taxes. Disposable personal income, what consumers take home after taxes, has been growing for 7 years. At 3.7%, the compound annual rate of growth in disposable personal income in the 12 months ended November 31, 2016, is lower than the 5.3% achieved in the last economic expansion. But, as the elves often say, it's not what you take home after taxes that matters, it's what you take home after inflation and taxes. What consumers take home after taxes and inflation, real disposable personal income, grew at an annually compounded rate of 2.3% in the 12 months through the end of November 2016. The growth rate is lower than the 2.8% achieved in the last economic expansion, but a larger dollar amount of income is growing at the 2.3% rate. That's another early gift from Santa. Real purchasing power per person grew 1.9% over the 12 months through the end of November 2016. Better than the last economic expansion from 2002 to 2007. Americans are a lot better off than before the Great Recession. Although Santa is for real, income stagnation is a myth. This chart of consumer sentiment, which is based on the latest data from the University of Michigan Survey Research Center, is useful in looking for early signs of irrational exuberance. Consumer sentiment has returned to a normal level since the global financial crisis of 2008. But it's nowhere near the highs of February 2000, just before the stock market bubble burst. Add the fact that sentiment is not overly exuberant to the list of gifts we received in the week before Christmas. Of course, consumer sentiment peaks after a stock market rally when people see their retirement account statements growing and feel wealthier, which makes this a lagging indicator because it tells you nothing about what to expect in the economy in the months ahead. An indicator designed to tell you what's ahead for the economy is the Conference Board's leading economic index, which suggests the economy will continue expanding into the first half of 2017. The LEI is comprised of 10 forward-looking components. Months in advance of the last two recessions, the LEI definitively rolled over and collapsed. So it is a good forward-looking indicator which is not showing any sign that a recession is likely in the foreseeable future. The average share price of America's largest public companies, as measured by the Standard & Poor's 500 index, recently broke its all-time record high and is trading at a price equal to about 19 times its trailing 12-month earnings. While not overvalued by historical standards, stocks are fully valued. The bull market is old by historical standards, and a drop in stock prices historically happens every year or two. However, recent investor ebullience is rooted in data like we saw in this week's pre-Christmas bundle, and key economic benchmarks are showing none of the signs that normally precede a recession. This 90-month-long economic expansion is far from the longest on record in post-war America. But this week's bundle of cheer from Santa indicates that the expansion could continue for many months or even years. With fake news flourishing and stock prices hitting new highs, please count on us for more timely, factual reports, like this one about Santa's early arrival. And please feel free to share the cheerful economic news with your family and friends. Our weekly report is the source of independent financial news, free from the noise of big media, uninfluenced by Wall Street or politics. It is just a prudent analysis of news affecting your wealth over the long run, plus the latest news about Santa.